Hello everyone and welcome to my third video, I think is now. And I haven't been posting in a while because I just moved out into a new office. So today we will go to the next lesson. I think it's going to be liquidity sweeps, and I will explain everything on how liquidity sweeps actually happen. We have learned the market will move up in an uptrend, the market will move in a downtrend, and market also can move sideways. So these are the only three types that market can move. We also have learned what a break of structure is, and I don't think I have explained what market structure shift is, but it's basically the same principle. Just when the market structure shift happens, it means it's a shift in direction. Let's say we have an uptrend here, and we keep breaking structure on the upside, and then the next break of structure is on the downside. And when this happens, this means it's a market structure shift, because this potentially means that if the market does this, then it will potentially start going on the other way. So it means it's a market structure shift, which means in this case it was going up and now it's shifted going down. So that's what MSS mean compared to break of structure. But what does liquidity sweeps mean? Especially liquidity sweeps, is one of the most important stuff to learn about the strategy that I'm gonna be using. So the point is, if I'm gonna explain to this like I would to a 5-year-old, right? There's a lot of people entering short positions just like this, and also buy position just like this. There's a bunch of people entering position in and out of the market every second of the market, right? And the hedge funds, the institutions, the banks, the big guys have the we also, the retail traders, can have access to this as well. They have access of seeing how many people are in the trade and where are those positions or pending orders actually laying on the chart. So they know, let's say right here is a heat map where it says there's a lot of orders here which want to go buy. So they want to come and trigger those orders. They want to sweep them out. They want to trigger their stop losses and then go in the direction, which means market is actually manipulated. And that's true. Market is truly manipulated. But that if we actually can see where the market is getting manipulated, that's when we can actually enter and make money with the big banks. So how do we notice the liquidity sweeps? Liquidity sweeps, I'm just going to be showing this on a, let's say it's like this. We have an uptrend, right? This is an uptrend. We already know that. So if the market wants to go higher, they need to collect money in order for them to actually push higher. Let me just take an actual chart and let me go to the 2 hour, or maybe 1 hour. Yeah. Let me just find a clean example of what I mean by this. We have a clear example here. I can take an example of this. This right here is clearly an uptrend. As you can see, the move up was always larger than the move down. That's why it made an uptrend. But something I can notice here, which you guys will be able to notice as well, is the manipulation or the liquidity sweep. For example, if we see this move like this, the move came up, it came down, it basically swept these lows, the market came out, swept these lows, and moved higher. What does that mean? That means since the market is pushing down, a lot of people were placing buys here. Yeah, let's buy, because it's pushing higher. And what the market did, it came down, it swept, it triggered their stop losses, so then they can be filled with money and they can go in the direction they want. That's the whole idea. And in an uptrend, liquidity lies on the lows, and in a downtrend, liquidity lies on the highs. Let's say if we are in an uptrend, there's always liquidity on the lows, and if we are in a downtrend, there's always going to be liquidity on the highs. Let's take another example I can see here. When the market is pushing higher, we can see it left a low here. It left this low here, right? And what market did, came, swept, and then pushed back. And the candles you're going to see in a sweep are usually just wicks. As you can see in this scenario here, the market basically had a candle closure below this low, but also wicked at the bottom. It didn't really close with a lot of power, with a lot of momentum. As we can see here, this is a cleaner setup of a liquidity sweep, because market only wicked and then closed above the low in this case. So this is the trigger where I know market is going to manipulate now. This is the trigger when I know this is the big banks pushing the price down just to trigger some stop losses or maybe pending orders so they can go in the other direction. And you can see this all over the charts. See, we have an uptrend here as well, and I can already notice a lot of stuff. And I'm going to show you ways it works. Let's say uptrend, downtrend. I'm going to show you how it works when the trend wants to shift. And I'm going to show you when the liquidity sweep is actually confirmed. So in this case, we have an uptrend. You can totally see. It's a very clear and beautiful uptrend. If I would draw this would be very easy to draw, right? Because it's so clean. And if I could push this aside, this is a very beautiful uptrend. You can totally see. Now, what do we have here? Let's see. First of all, we have this. Market was pushing down, the price came, pushed, wicked below, and then started a whole new trend. But let's not take this as an example, because this was already an up and down trend, and this is an example I'm going to be taking later. What are the other examples? Let's say here. Right here, we have like very small lows, and what market did, it just came, triggered their stops, and then went back in the other direction. We also can see this here. This is like a tiny low. I wouldn't even consider this a low. For the sake of explaining, I will take this as a low now. The market would just sweep and then move up. So this is the idea. When market is moving on an uptrend, the market wants to sweep those lows so it could move higher. The same exact example can happen on the downtrend. So if we are going down, the market is going to want to sweep some highs, one or two highs, and then actually keep going in the direction lower. So you can see this one here. This is a complete manipulative wick, because here we have a low. We also going to have a low here. So the market wanted to have another stop, wanted to trigger more stop losses so they could do the last push up before they actually start pushing down. So this is what liquidity sweep is in its essence. Let me find a downtrend. I want to find a downtrend. I want to take examples on the downtrend. Here. We can see this is a complete downtrend, right? The move down is bigger than the move up. If we do this on a drawing, the move down is bigger than the move up. The move down is bigger than the move up. That will create a downtrend. Now, how does this work? We see we have a completely downtrend confirmed by break of structures and so on and so forth. But look at this. When price was pushing lower, price came and swept these highs. Because why these highs? Because on a downtrend, I want you guys to write this down. liquidity lies on the highs. On a downtrend, liquidity lies on the highs. On an uptrend, liquidity lies on the lows. And when the market is ranging, basically liquidity is lying on both sides, right? Because market might sweep this part and then actually go to the other side. To the power of 3. This is stuff I will be talking about later. I don't want to get you guys like I don't want to fill you guys your guys' heads with a lot of stuff. I want to go this slowly. So we can see here this is a push up and then it went down. That's market manipulation because market needed to have those stop loss triggered so it can go down. We can see it here as well. This is more of a candle closure. We also have that as liquidity sweep sometimes. What do we have here? Another sweep. Boom, it went down. What do we have here? Another sweep. Boom, it did the last part down. And how do we confirm? Because not when we see this could easily like close up here and then just start an uptrend. But how do we confirm it's an actual liquidity sweep? We do that by actually seeing a break of structure after the liquidity sweep has been done. For example, we see here is a liquidity sweep, but until we see a break of structure on the downside, we do not confirm that as a liquidity sweep. When the sweep happens and then the break of structure, we understand that the market really was taking those highs here to move lower because that break of structure confirmed us that the liquidity sweep is true and it's going to move lower. And this stuff has like 75% of a win rate. As well as here, let's take this for an example. It pushed up, as I said earlier, this could just totally start going up from here. Why? Because we haven't confirmed yet where the break of structure is. When we confirm the break of structure, like this is the indicator that the price wants to move lower. Let me take some other examples. And you can just see this everywhere. In a ranging market, the market was ranging, liquidity sweep. Market was still ranging, liquidity sweep, break of structure. Price moves lower. Liquidity sweep, break of structure, price moves higher. It's very simple stuff, right? And this is like a really good one to do. Price started going up, and every single one of these lows are protected, right? There's maybe a sweep here, but this wouldn't be counted as a low. This low here and this low here until this last low. This last low got taken out, and where do we confirm? We confirm when the break of structure happens. So all of these lows were left alone, and then price decided that here they're gonna come and stop the trades. A lot of people will be seeing price falling, waiting for a pullback, and then they will start shorting. So a lot of people would go sell here because market is now reversing, but most of them didn't know that this was an actual liquidity sweep, right? This was just a sweep to move on the direction that the market makers wanted to go. We have another one here, clear as day. Check this out. This is a downtrend, right? What is this? This is like a small high. Look at this. Price just pinched it. You can actually mark out these with buy side liquidity, sell side liquidity. This is buy side liquidity, and you can do this sell side liquidity. You can just put an arrow, like do the dotted line, the colors on this one, or like this style. You have this. Nothing fancy, just also a text. Forgot here. The text is like a couple dollar signs. You could just leave one and you could put any color you want. Basically, you don't have to copy mine. But this just indicates that here is the money laying. The money is laying here. Price is always a magnet to that, to the money, to the sweep, to hunting stop losses, and then actually making the biggest move. The biggest moves in the market are powered by liquidity sweeps. Let me just show you guys this. For example, S&P 500. I just want to show you guys this real quick. I'm going to take the weekly chart. Actually, I'm going to take the monthly chart. Yeah. Check this out, guys. Look at this. This is going to blow your mind. March 20. What was happening on March 20? On March 20, it was Corona, right? Everyone was in lockdown. Everything was going down. All the markets were going down. I wasn't even trading at this time. I didn't even know about trading at this time. So look at this. What was market doing? This is as simple as it can get. The market was going up, and then it decided to come down, sweep this low, so they can push higher. What is this? What just happened here? This is last month. Look at this. It's a sweep, and then price moved higher. So look at this. This was a liquidity sweep. We have a break of structure on the upside. Price continues to move higher. We have a liquidity sweep. Now we can wait for the break of structure to occur here, and then we could be 75% sure that the market is going to still keep going up. So this happens in the bigger time frames as well. Not the monthly. So this is the triggers. Also, where liquidity sweep happens, because these are the types of liquidity sweeps we learned today. Where does it lie? First of all, what is a liquidity sweep? I want you guys to write everything down that I'm saying. What is a liquidity sweeps? Banks, institutions, and hedge funds are always hunting for the obvious stop losses. They always lie in a high or in a low. What else? Where do we find liquidity? And let me just get back to the first one. But why do they hunt? Because they want to collect money so they can go on the side they desire. On a downtrend, liquidity lies on the highs. On an uptrend, liquidity lies on the lows. And when the market is ranging, there's liquidity on both sides, basically. And the third one I want to teach you guys is when we see this, and this is a break of structure, a break of structure, a break of structure. Market is moving up by breaking on the upside continuously. And then what did market do here? Market broke structure on the downside. This is a market structure shift, MSS. This is a break of structure, but it's in the opposite way of what direction we were going. So this means that potentially we have a change in direction. And what you always see on this is the price breaks structure, sweeps liquidity, and then starts going on the other direction. You can always see this. Let's see, for example, this. I'm going to take this one as an example. Let's see what happened here when the price starts changing directions. So price was moving high, breaking structure on the upside, breaking structure on the upside, sweeping liquidity, breaking structure on the upside, until here. This is so tiny. I think you guys, yeah, I think you can see now. If I zoom in, look at this. It swept liquidity and then came down and broke structure. And then a whole new move happened after that. A whole new move. This is what I was talking about on the ranging markets. Liquidity is going to lie on the highs, on the lows. You see, liquidity here swept these lows, broke structure on the upside, pushed the price higher. Swept liquidity up here, broke structure down here, price moves lower. ABC stuff, guys. ABC stuff, but it's really, really, really important. It's really important. Let's see, what do we have here? We have a downtrend. Market is going down this way. And then we have a couple highs. What do we see here? This is a liquidity sweep. What do we see after that? We see a break of structure. Price moves higher. Very simple stuff. What is this? This is an uptrend. Price, what did price do? Swept here. It swept, or basically you could see this as a break of structure on the upside, but when the break of structure on the downside occurs, that's when we know that this was a liquidity sweep, not a break of structure, because price wants to go lower now. So what I want you guys to do, I want you guys to go on the hourly chart. I want you guys to go at gold. You could go at euro dollar. You could go at GJ, whatever forex pair that you want. And I just want you guys to, first of all, identify an uptrend. And just put two trend lines here like this. Just identify an uptrend. After that, start marking out the lows. This is the low, this is the low, this is the low, this is the low, this is the low. And after you do that, check if any of those lows were swept. So in this case, this low was swept here. You can count this as a break of structure on the downside, but when the break of structure on the upside occurs, then that's when we know this here wasn't a break of structure on the downside. This was just a liquidity sweep because we are already on an uptrend. So this is a break of structure sell, and this is break of structure buy, or in this case, this was sell side liquidity. So it takes out sell side liquidity. People are saying, oh, it broke structure here, let's enter shorts. And they get stopped out. So when it goes down like this on an uptrend and it actually closes, you don't have to get excited and say, yeah, this is a market structure shift, it's actually shifting. Because if it jumps back and breaks structure on the upside, that means price here just swept liquidity. It didn't want to stay here for long. It was just coming back for liquidity to move higher. And do we see any other thing? Not quite. This is not quite a low. We could see this is a potential low, but I wouldn't really count this as a low. This is that's not a low. That's just a move up. So this was the actual liquidity sweep that occurred here. Look at this. What is this? What caused this move? And you can see this, guys, every time. You will never see a big move. Test this, please. You will never see a big move happening without price sweeping liquidity. So whenever you see a big move like this, just go back here. Like, let me check. Somewhere price wanted to sweep before making this move. And then they stopped again here, as we were taking as an example. They stopped again here to collect more money to go on the other side. So what happened here? It swept liquidity on the upside, and then this is a break of structure on the downside. So what price did? Swept liquidity, break of structure. We know this is a market structure shift. You could write MSS at the text here. You can do MSS because this is a market structure shift. The market is shifting here because it swept liquidity and we have it confirmed here. And the price wants to go lower. This is what you want to do on an uptrend. On a downtrend, you want to do the same, except you want to monitor the highs. let me do this, yeah. Even if you just see one liquidity sweep, even if you don't see at all, you want to go back to the move and see how the price started. Why was this move occurring? So on the downtrend, on a downtrend, we mark out the highs like this. This is a high, high, the high, the high, 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 high. Whatever, you could do all of them. But I could only see one sweep here, and it's this one. So when you mark out all the highs, you want to go back from the first one, and you want to go down from it. This one actually did not sweep. This one did not sweep. You don't want to go back way further. You just want to see what happened on that downtrend. Until we came here. As you can see, price just pushed the wake up. This is the highest confirmation of a liquidity sweep, when price doesn't actually close with a candle. This is the best form of liquidity sweep. So what happens here? It sweeps liquidity, comes back down, break of structure. What does this mean? This means that the downtrend is now confirmed. Price moves lower. And on a ranging market, I want you guys to just see a ranging market somewhere. Just find where market was just laying around for nothing, just like here. And you just want to mark out liquidity sweeps on both sides and then break of structure. Liquidity sweep, you can do sell side liquidity. If you want to mark these out like professional. Sell side liquidity taken, break of structure on the upside. What do we have here? And price continues moving higher. What do we have here? Price takes these buy side liquidity and then breaks structure on the downside. Price moves lower. It's not the point to say, the price broke structure, but it didn't go enough low. It should go more. It should go this. Nothing is 100%. There's no 100% in this game. This has 70 to 75% of a win rate. If you trade it on the higher time frames, it's going to have even more. If you trade it on the lower time frames, it's going to have somewhere between 65 to 71% win rate, which that is my win rate. I want you guys to just do this for at least 30 minutes a day until you actually catch. Yeah, until you start seeing them. Oh yeah, this is an uptrend. This is the sweep. This is the sweep. This is the sweep. Where's the break of structure? Break of structure here. Trend confirmed. I want to see. This is the sweep. This is the break of structure here. Yeah, sweep of liquidity, break of structure. We are already on an uptrend. I want you guys to train this eye until it's inevitable. You will come into the markets and just see the liquidity sweep, right? You just see this, and then you definitely immediately confirm with a break of structure. Sweep, break of structure, moved up a little and went down. Nothing is 100%, as I told you. But this is, let me say, one of the best confluences you will ever learn in trading. What is this? This is a high, another high, liquidity sweep, break of structure. Price moves lower. What is this? Liquidity sweep, break of structure, price moves lower. Anywhere on the charts. I'm just gonna go to the 4 hour, and I'm just gonna go to one big move. Let's say this big move. This big move here. This big move didn't happen by accident. Look at this. Liquidity sweep, break of structure, pushes price higher. I'm not gonna show you guys how to enter this now. This is not how to actually make money. We are just building confluences together. So at the end, you will be taught on how to enter, how to manage the trade, everything. In this bootcamp, you will learn every single thing you will ever need. If you actually needed a strategy and a mentor, this is your the freest shit you will ever get. The only time you should be paying for a mentorship, and I keep saying this over and over again to friends and students and everyone, the only time you should be paying for the mentorship is for guidance. You have plenty of strategies on YouTube. You have plenty of mentors on YouTube. But you never want to purchase a mentorship just because of the strategy. Yeah, I've seen his strategy. I want to learn that. No, you don't have to buy that, because those same concepts somebody else could be teaching for free. You want a mentorship. Let's say if you want to join my Discord, or you want to have me as a mentor, the only thing you would need me for this is for me to actually see your homework, for me to actually help you with this strategy. For me to, you should be able to ask me questions, and I should be able to give back to you the feedback that you actually need, because I have years of experience with this strategy. That's the only point you need a mentor. You don't need a mentor for an edge. You find strategies all over YouTube, and I will be talking about psychology, money management, trade management, risk management, everything in this. But the only time you should be purchasing something from someone is for you to get deeper into that, for you to be able to ask questions. Here's the trade I took today. How is that? Is this a good one? Is this a bad one? That's the only time you should be willing to pay for someone. Should you? Yes. I've paid over $7,000 to $8,000 of courses. One costed $300, one costed $2,000, one costed $1,000, one $800. I bought every other course I could find on the influencers. Were they good? Some of them, yeah. If I could go back on time, would I do it again? Yes. Because I know this is a really hard industry. But I was thinking wrong when I bought the mentorships, because I was thinking, yeah, this guy probably has that 90%, 80% win rate strategy with a 1 to 3 risk reward that was going to make me a lot of money. That's the type of bullshit I was thinking. But that's wrong. You don't need that. You don't need that. If you're going to buy a mentorship, please buy it for guidance. Please buy it so you can actually have a conversation with someone. You can actually ask questions, especially the mentor. So that's why you should buy it, right? You don't need another edge. Trust me, there's a lot of edges on YouTube. You can have an 80% win rate with a 1-to-1 risk to reward. You can find 65% win rate with a 1-to-2 risk to reward. You can find a 50% win rate strategy with a 1-to-3, 1-to-4 risk to reward. And the better you get, this is what people don't understand about psychology. And I mean, this is what people don't understand about edge. They think, like most of you guys are going to do anyway, they think you can learn a strategy on YouTube and go back and just start implementing it into the market and immediately start making money with it. That's totally far from the truth. Why? Because I have a lot of experience with this one, and I came up with some of this stuff myself. The time frame selection, some of the stuff I do, it's not because key levels, liquidity sweeps, and these stuffs are basically made by guys 20, 30 years ago, right? Nobody's inventing shit these days. So don't get confused. My methods, my this, my that. Yeah, you could have some mix into that, but you didn't create shit. Nobody in this influencer trading industry created shit. So I don't want you guys to learn a strategy and then start implementing it, and you go 4 losses in a row and you're like, nah, this doesn't work. And you go back to the next one. Because the more you spend time with this strategy, the more profitable you're going to get. When I'm going to be talking about journaling, risk management, all of that stuff will add to the strategy, right? So when you learn this strategy, you don't have to expect to make money with this the next day or the next week or the next month or the next 3 months or the next 6 months, because you need experience with it as well. So this was it for me today. I really thank you guys for tuning in until the end of this video. I will be uploading more now because I just moved into a new office, so I could have more room with myself. I was actually making the videos from my home. So thank you guys for watching, and I'll see you guys on the next one. Bye-bye.